Hello everyone. Today I'm going to presenting about ratio analysis of Cargills Ceylon PLC. This presentation covers about profitability, liquidity, efficiency, solvency and investor valuation. My name is Malik Sharma. I am fourth year student of SLE at Gampaha. I am studying High National Diploma in Accountancy. The subject is corporate reporting practice. I am going to describe about overview of company. This company is established in 1946. When we look at their main business activities, they are mainly involved in retail supermarkets through Cargill's Food City as well as food manufacturing. The main shareholder of the company is City Holdings plc, and the company is led by Chairman and CEO is Mr. Lois R. Page. Now let's look the financial period. The annual report covers from 2024-2025. In terms of company size, they have around 2,475 employees. Looking the financial performance, the total assets are about 23.9 billion rupees and profit after tax is 3.87 billion rupees. The company has a revenue of around 21.4 million rupees. I am going to discuss the profitability ratio. Under the profitability ratio, the first one is gross profit margin. The gross profit margin calculated as gross profit divided by revenue multiplied by 100. 2025 gross profit margin is minus 2.56%. 2024 1.73%. Gross profit margin decrease indicates weaker profitability compared previous year. The next one is net profit margin. The net profit margin calculated as net profit divided by revenue multiplied by 100. 2025, the net profit margin is 18%. 2024, the net profit margin is 10.9%. The net profit margin increase indicate stronger profitability compared the previous year. Next one is liquidity. Under that liquidity, the first ratio is current ratio. The current ratio calculated as current asset divided by current liabilities multiplied by 100. The current ratio is 2025 0.33, 2024 0.38. The current ratio decrease indicates weaker liquidity compared the previous year. Next one is quick ratio. The quick ratio calculated as current asset minus inventory divided by current liabilities. Quick ratio is 2025 0.33, 2024 0.38. Quick ratio decrease indicating slightly weaker liquidity compared the previous year. Next one is efficiency. Under that efficiency, the first one is inventory turnover. The inventory turnover calculated as cost of sale divided by average inventory. 2025, the inventory turnover is 62.2 times. 2024, 7.3 times. Inventory turnover increase indicates much improved inventory efficiency compared the previous year. Next one is asset turnover. The asset turnover calculated as revenue divided by total asset. The asset turnover is 2025 8.9 times, 2024 0.001 times. Asset turnover increase indicates a significant improvement in asset efficiency compared to the previous year. Next one is solvency. Under that solvency, first ratio is debit to equity ratio. The debit to equity ratio calculated as total debit divided by shareholders' equity. 2025 debit to equity ratio is 0.08. 2024 0.05. Debit to equity ratio increase indicates slightly higher leverage compared to the previous year. The next ratio is interest coverage ratio. That ratio calculated as EBIT divided by finance cost. 2025 interest coverage ratio is 1.17 times. 2024 1.32 times. Interest coverage ratio decrease indicates reduced ability to cover interest expense compared to the previous year. The next one is investor valuation. Under that investor valuation, first ratio is earning per share. Earning per share calculated as net profit minus preferred dividends divided by number of shares. 2025 earning per share is 15.03. 2024 earning per share is 12.12. Earning per share indicates higher earning per share compared to the previous year. The next ratio is price earning ratio. That ratio calculated as market price per share divided by earning per share. 2025 price earning ratio is 29. 2024 price earning ratio is 29.7. Price earning ratio decrease indicates slightly lower market valuation compared to the previous year. Based on the ratio analysis, recommendation for Cargills Ceylon plc. First one is profitability. Improve cost control and pricing strategies to recover gross margin. Focus on reducing cost of sales. Second one is liquidity. Maintain adapt current asset to meet short-term obligations. Improve working capital management. Third one is efficiency. Continue effective inventory and asset management practice. Sustain high turnover levels. Next one is solvency. Control debt level to reduce financial risk. Improve operating profit to strengthen interest coverage. Last one is investor valuation. Enhance profitability to improve market confidence. Maintain consistent earnings growth to support share value. Finally, I explain the conclusion. The company demonstrates improved efficiency and earning growth, but needs to focus on controlling cost and maintaining financial stability for sustainable performance. Thank you for watching my video. If you have any question, put the comment below.